This week, we're going to talk about health savings accounts. By doing this, you will pretty much guarantee that you're going to have more money available for healthcare expenses at a future date. So that's the smartest way to use the HSA account. We've got a new segment for you. The Ignite Money Brief. Department of Government Efficiency has been finding a lot of stuff. A couple of interesting things that they found in the last week. Why would you give a loan to a 9-year-old? Hello everybody, Ignatius L. Jackson CPA here with another awesome video for you. Today, what are we talking about today? An interesting topic. We have a deadline coming up, tax deadline, April 15th, 2025. So today we're going to talk about a few things that you might want to consider doing before that deadline. Chiefly among them, making a contribution to an HSA, making contributions to Roth IRAs, etc. Okay, so something to kind of check out, tune in, and listen on. Okay, we've got a new segment for you called the Ignite Money Brief. Who knows? We might change the name here in the near future, but we're going to go with that for this week. The Ignite Money Brief. We're just going to talk about a few little current events that you might want to pay attention to and think about. So recently, on last Friday, we had the Treasury Secretary and FinCEN. They issued an initial final or interim final rule, whatever you want to call it, right? Interim final rule, I think is the official term. Let's just get it right. So they issued one of those for the business owner information reports. So even though they previously made a post or a tweet on social media saying that they were going to do it, they actually officially did it. And so business owner information reports for domestic entities, it's officially dead. Don't need to worry about it. If you already filed your report, I don't know what they're going to do with the information. They'll probably just keep it. If you haven't filed your report, don't worry about filing the report at this point. Unless somebody tries to sue them, which they've been suing them left and right, so who knows, they might change their mind on that, okay? But for now, don't have to worry about it. Another interesting thing that happened, Doge Group, Department of Government Efficiency, has been finding a lot of stuff. A couple of interesting things that they found in the last week. Roughly about 350 million people were paid, or I should say children, were paid or given loans under, I believe, the COVID area stuff or just some sort of SBA loan. And they were under the age of like 9. $350 million worth roughly, approximately, for people under the age of 9. That's crazy. Also, there's about the same amount for people that are over the age of 120 years old. Clearly there's some issues with the Social Security database, not showing people as either being dead and then not sharing information with other departments in terms of their age, because why would you give a loan to a 9-year-old? There was, I think, one situation where it was the 9-month-old ended up getting I think $1 million or something crazy like that. Maybe I'm probably remembering the number wrong, going off the top of memory here. But yeah, that's pretty interesting. So definitely some interesting stuff coming out of the Department of Government Efficiency. We also had an awesome interview that happened with Howard Lutnick and the Treasury Secretary Scott Bessent, done by the All In podcast. If you haven't checked that out, highly recommend you go listen to both those interviews. It was very insightful into where some of this stuff came from, where the ideals came from, a lot of this stuff and how they're tackling it. There also was recently, just yesterday actually, on Bret Baier's Fox News show, an interview with several Doge members, in addition to Elon, where they were talking through some of the stuff on how they're finding it, what they're doing, all that kind of stuff. Some stuff that you might want to be that you could be very interested in, might want to take a look at, okay? That was this week's Ignite Money Brief. Hey, if you have a different name that you think might be better for the Ignite Money Brief, feel free to shoot it over to us. We might consider switching that out for you. On to the topic of the day. So we got April 15th deadline around the corner here. So some things that I just want to kind of mention to you for you to consider, okay? Contributing to Roth IRAs, traditional IRAs, health savings accounts, and Coverdell education savings accounts. You have until April 15th to make contributions for all of those. For Roth IRAs and traditional IRAs, the limit is $7,000 for 2024 tax year. If you're over the age of 50, you can put it in an extra $1,000. For HSAs, the limit is $8,300 for 2024 tax year. And if you're over the age of 55, you can do an extra $1,000. And if both you and your spouse are over the age of 55 for the HSA, you can each do an extra $1,000 into the HSA, but you have to each have your own separate account. So that's another cool tip that a lot of people often miss. So really the maximum amount that you could put into an HSA for 2024 is $10,300 if both you and your spouse are over the age of 55 years old. Another cool thing that I just want to make sure people are aware of. And then for Coverdell education savings accounts, you have $2,000 is the maximum threshold. For whatever reason, that amount has not changed for several years. I really wish they would inflation adjust that amount because it's a super cool feature, much better than a 529 in my opinion, because you can invest it in whatever you want. that's on for a future day's topic, but something else to kind of think about and consider. So let's go and continue with our Black History Month segment, where we're doing a little recap of the post or the tweet that I did for Black History Month, where I did a post every day of the month with another cool either financial or tax tip to think about and help you towards your financial journey. And so we're going to continue on that and talk a little bit more in detail about health savings accounts. So we talked about Roth IRAs, traditional IRAs on last week's episode, okay? And so this week we're going to talk about health savings accounts. Dive into it a little bit further. One of the things, obviously I just mentioned the deadline for 2024, and then also the amount that you can put in. We already covered that, but let's talk about how you use the account. So the best way to use an HSA health savings account is not to use it for the medical expenses as you incur them. The best thing to do is to set it aside. So you want to set that account, you want to set those funds aside, invest them, and let them grow. Okay, you can still use those receipts. You can still get a benefit for those at a future date. But if you take a tax deduction for those medical expenses on your tax return, then you lose the benefit of getting reimbursed for those expenses at that future date. So you have to pick one or the other. Either you take it as an itemized Schedule A deduction, or you save it for your HSA reimbursement at a future date. Don't double dip here. How will the IRS know? Just be honest. I mean, be ethical, be honest with yourself. All right, you're right. Maybe the IRS wouldn't figure it out, wouldn't know, but come on guys, let's be ethical and honest with yourselves. Itemized deduction or HSA reimbursement at a future date. By doing this, by letting the money grow and investing it and letting it grow exponentially, you will pretty much guarantee that you're going to have more money available for healthcare expenses at a future date by doing it that way, instead of by whenever you incur expense swiping that HSA debit card or getting reimbursed right away for the expenses on your personal credit card. So that's the smartest way to use the HSA account, because you will ultimately create more money for yourself at a future date. Some other cool things about HSAs that are often kind of forgotten about. It really acts like a additional retirement account. It's an additional retirement account that you can use for yourself, because it's a way for you to be able to pull money out tax-free once you retire. You can save it, invest it, and then when you retire, go ahead and pull that sucker out tax-free by keeping all those receipts stored up like we just talked about. And so it's really an additional retirement account. Furthermore, if you don't end up using the whole thing, then it just gets treated pretty much like an IRA account, where you can still pull the money out after you reach retirement age and just treat it like an additional IRA balance that you have. But if you use it for medical expenses, then when you pull it out, it's all tax-free. Super, super cool and powerful. Highly recommend that people take advantage of health savings accounts. They're highly underutilized, mainly because I think people don't really understand them, okay? And oftentimes when you do your analysis on whether it's better to have the HSA or have an account that has a lower deductible, you don't really factor in the premiums and everything into the full calculation. And really, if you do the math right, usually there's really not much of a difference between having a lower deductible and having the high deductible, even if you have a lot of expenses every year. Doing HSA probably is going to be a better all-around solution for you, financial management standpoint and a tax planning standpoint for both of those situations, okay? Obviously, one of the most expensive things in retirement is going to be healthcare costs. Generally speaking, you will use your HSA account once you reach retirement age. So it's just good practice to, take the time to build it up, let it grow. Don't, use the money right away, and just let that be available for you at a future date. Another thing from an estate planning standpoint, okay? When you pass away, the account can pass to your spouse tax-free, and they can use it just like it's their own HSA. So that's a pretty cool benefit. You make your primary beneficiary your spouse, it goes to them, they then use it however they want to use it, and then whoever they decide to leave the beneficiary to, assuming they don't get remarried, then they end up having to pay taxes on it if you don't use it all before you pass away. But one cool thing is you have 1 year after your death to reimburse yourself for all the final medical expenses from whoever's account that is that passed away. That's something else that people don't really think about or consider. A lot of times you have a lot of end-of-life expenses, and you can actually use the funds in that account to cover all those end-of-life medical expenses, and if there's dental stuff or whatever else there might be for kind of end-of-life stuff, as long as it's medical related. And so that's another benefit of being able to use that account. And then whatever you don't use, pass it to your spouse. If it passes to anybody besides your spouse, then it's just treated like an IRA beneficiary designation is treated, and you guys can kind of go from there. So that's really it about HSAs. You know, it's just a super powerful account that people often kind of forget about. If you ever want to learn some more about it, there's obviously more to it than that, but those are the key things, right? Remember the contribution limits, remember how to use it appropriately or effectively, and you know, just really kind of set some money aside. So there's just so many cool things you can do with that. Really take advantage of that and let your money grow and continue on your financial journey. That's today's video. You know, something nice and quick. Hopefully everybody enjoyed. If you have any questions or anything like that, feel free to go ahead and ask away. Otherwise, we'll be back with more cool info next week. Hope everybody has a good one. Peace.